Welcome to Trading Day. We're tracking shares of UPS under pressure. It's the worst performing stock right now on the S&P 500. We don't see a plunge like this every day. In fact, we haven't seen a plunge like this in 15 years. It's trading at the lowest level since 2020. Now, the source of the sell-off is we saw a pretty sizable miss relative to expectations, earnings falling materially from last year, and revenue also coming in declining about 2% from last year. This is a company that's also in the midst of a turnaround, to maybe placate investors. It did announce a resumption of a buyback. Let's bring in Daniel Imbro, who is the Managing Director of Equity Research of Transportation at Stephens. And Daniel, my apologies. I've been saying that you're a buyer, but you're actually equal weight. You've been equal weight into the print, so you're neutral on this. I mentioned part of this has been sort of a turnaround play. It's obviously not working out. When you look at the quarter for UPS, what went wrong?
Yeah, well, good afternoon. Thanks for having me, Amber. When I look at the quarter, a couple things maybe stood out to us. Obviously, volume growth of very low single digits. Maybe that was closer to expectations, but this mix shift within the business continues to weigh on overall profitability. What the company is seeing is ultimately a reflection of the economic pressures you've talked about. We're seeing a negative trade down. So you're seeing air freight trade to ground. Within ground, you're seeing a shift towards what's called shore post. That's their low-cost offering, kind of economic offering. And so you're seeing this trade down weigh on unit economics. And when you look at the weakness today in shares, obviously part of it is due to the earnings miss. I actually think investors expected a miss this quarter. I think the bigger driver is probably the back half. So the commentary around the back half and the reduction in the full year guide reflects that these mixed headwinds continue. It reflects a pretty tough backdrop, at least through the end of this year. And it calls more into question the out years. We recall earlier this year, UPS provided some multi-year targets that assumed some steady growth the next few years. And I think investors today are grappling with the feasibility of some of those targets with a reflection of how maybe tough the macro is today.
I mean, they didn't torpedo their full year sales forecast. I mean, they nudged it down. What's a couple $1 billion between friends, I guess. Do you think the market is overreacting?
You're right. The sales adjustment was minimal. It actually kind of just tightened the range around the midpoint. The earnings reduction, or the implied earnings, they lowered their operating margin guidance by about 90 basis points at the midpoint. So there is a larger reduction in actual earnings for the back half of the year, which reflects these mix shifts we're talking about. To your question, your second part around overreacting, while it might be tempting to try to step in here, we've recommended to investors today to continue to stay on the sidelines. Just struggle to underwrite the back half. Even looking at this adjusted lower margin guidance, it still implies a pretty meaningful pickup through the third quarter into the fourth quarter. Management on the call reiterated they expect to end this year at a 10% margin. That's where they expected 90 days ago. But obviously, it's going to be more of a hockey stick to get there later this year. So with the lack of visibility that we have, we recommended not stepping in despite the pullback. And we think there's other opportunities within the freight sector that offer a more compelling risk reward.
Well, is FedEx one of them? Is this UPS's situation a negative read-through for FedEx, which has handily outperformed UPS?
Yes, well, that is definitely one of the names we've liked this year, and we continue to recommend. So we recommend buying shares of FedEx today on this pullback. If we look at what has caused some of that divergence this year, at least part of it is that last year FedEx gained a lot of market share around UPS's union negotiations, and essentially FedEx has executed well. They've onboarded that freight, and they've actually retained more of that market share than UPS thought. And so FedEx has proven their service is held in there. They've retained some of that market share. They're executing pretty well on that core ground business. At the same time, you have a self-help story on the express business. That is FedEx's air freight business. They're taking meaningful costs out of the operating model there, which should improve margins. And then the third piece of the thesis is last quarter, they announced a strategic review of their less than truckload business called FedEx Freight. If you look at where the public LTLs are trading, there's a meaningful multiple divergence between the public LTLs and FedEx. So we think there's a value creation opportunity if they were to spin that business, which we think is the most likely outcome of that review. So we think there's a few catalysts and ways to win. I don't see a ton of negative read-throughs from the UPS print. Is the economy still soft? Absolutely. I think that's relatively base case right now across how FedEx laid out their year. And so I do think we would be buying shares of FedEx today.
Well, let's broaden it out to the transport sector, which you do cover. You mentioned the truckers. They've been under pressure, but you got eyes on a lot of them. What's behind that call?
Yeah, so we do. We think within the truckload sector, that'll be the early cycle play. We do see some opportunities. Typically, the way these cyclicals are trading is you want to be accumulating shares ahead of the turn. And what we think we're seeing in the truckload market is signs of a market tightness. After COVID, we brought in a lot of supply. We've been meaningfully oversupplied for a few years, overcapacity that's weighed on rates. We've seen the last really 12 to 18 months capacity slowly trickle out of the industry. At the same time, we think demand has found a relative floor. And so as we head through the summer, we headed through 2Q, we saw more supply demand balance in the market. We think that continues through the back half. You heard UPS today. We've heard from others. We do expect some peak season in the back half. And I think you typically want to be buying these early cycle names ahead of that tightening in the market. We do think you'll see rates begin to move higher year over year starting in the fourth quarter. So we think on the truckload space that's behind the buy calls on some of our favorite names in that space right now.